You're curious and wondering, what are the tax perks of contributing to your retirement account? That's a good question. Let's find out today. Check this out. There are two main ways to see tax benefits from contributing to your retirement account every year. The two ways are through retirement tax credits or either through retirement tax deductions. Okay, so let's break this down a little bit. Retirement tax credit, also known as the saver's credit. So for most professionals who contribute to a SEP IRA, traditional IRA, a Roth IRA, a 401k, a 457b plan, a 501c18 plan can essentially take this saver's credit. Now, the real question is to ask, are you even eligible for this credit? So you may be eligible if you're 18 years or older, you're not a full-time student, or you're not being claimed as a dependent on someone else's tax return. The amount for the credit that you can claim definitely depends on your adjusted gross income. It also is equal to up to either 50%, 20%, or 10% of your annual retirement contribution. So, let's give an example. You may claim a maximum up to $2,000 for your contributions, or you may claim up to $4,000 for married filing joint. Okay? So, what contributions are really eligible for this tax credit, you're wondering? Well, rollover contributions are definitely not eligible. No rollovers, sorry. So there's that. Now, let's just imagine for a moment. You're a salaried lab tech who makes $38,000. You contribute $1,000 to your IRA, okay? So now your adjusted gross income is $37,000. Now, with that, as your adjusted gross, that gets calculated into how much retirement tax credit you may claim. So you may claim up to 50% of that $1,000, which equals $500. Let's get this money. IRA contributions must be made by the due date of your tax return. And for most taxpayers, that's April 15th. So now, let's talk tax deductions for retirement contributions. So the tax deduction for contributing to a SEP IRA or a traditional IRA is $5,500, or 100% of your includable compensation, whichever is less. Now, the interesting thing about this tax deduction is there is an income phase out, right? So the IRA deduction is reduced by certain income levels. So for for example, you're a single filer, you make $63,000. So starting at $63,000, you hit the phase out where your IRA deduction will be reduced. Now for married joint filers, the phase out starts at $101,000. Okay, so say you're 50 years old by the end of tax season. You can legally contribute up to $1,000 more than other taxpayers. Yes, that's correct. That means you can contribute up to $6,500. So that means a larger tax deduction for you. Cha-ching, let's get this money. Now there is a penalty for making either excessive or extra contributions to your IRA account. Okay, so if this is your situation, you may have to pay a penalty tax, also known as an excise tax of 6%. And if you make early withdrawals before the age of 59 and a half, you also have to pay a penalty. And you know what we say, we hate those penalties. Avoid those penalties at all cost. Benefits of making retirement contributions will help your taxable income, and
in many cases, reduce the amount of taxes you have to pay at the end of tax season. I help multicultural business owners and professionals pay the least amount of taxes like the top wealthiest 1% of the world, accelerate their ability to acquire business financing, and ensure that they're tax audit ready every month.
Hey, what's going on, my beautiful people? It's your tax guru from the Clark & Co. office. Thanks so much for watching this episode on Tax Perks TV. Make sure you subscribe and like this episode.